All right, so now we're going to talk about investments, the risk and return. So there's cash investments. That's basically when you deposit money into a bank account. This is called a cash investment. Now, because bank accounts up to $250,000 are insured by the federal government, there is no risk of losing the principal you've invested. Now, the account's interest rate guarantees a certain percent increase in your investment, and that's called a return. So, you might have an investment or your savings account might have a interest rate of 1%, so you're going to get 1% return. Okay. Then we have something called stocks. So this is investors purchase a stock or a share of an ownership in a company. Now, the shares indicate the percent of ownership. For example, if a company has issued a total of 1 million shares and you as an investor own 20,000 of these shares, then you're going to own 20,000 divided by 1 million or zero point zero 0.02, which is going to be converted to a percent, which is 2% of the company. Okay. And so any investor who owns some percentage of a company is called a shareholder. So if you own stock, you're a shareholder into some company. Now, if you buy or sell stock, that's referred to as trading. Now, the shares of stock need both a seller and a buyer to be traded. Stocks are traded on the stock exchange, so you've probably heard of the New York Stock Exchange, and that's how most of it's done. Now, the price of a share of stock is determined by the law of supply and demand. So, if a lot of people want the stock and the demand is that there's a lot of it wanted, the prices are going to go up. Now, if not very many people want it and there's a lot of it but nobody wants it, then the prices are going to go down. Okay, so that's kind of how supply and demand works. So there are two ways to make money by investing in stock. One, you sell the shares for more money than what you paid for them, and in which case you have a capital gain on the sale of stock. There can also be a capital loss by selling for less than what you paid, or if the company goes bankrupt. So that's what you don't want to happen, but it sometimes happens. So capital gain is what you want to have happen. Now, the second way is when you own the stock, the company distributes all or part of its profits to shareholders as dividends. So each share is paid some amount of dividend. And so if you own 2 million shares of something and they pay, 2 cents on each dividend, then you're going to get, 2 cents times that $1 million. And so that's what you'll make. So the amount you receive depends on the number of shares you owned. So some companies reinvest all profits and do not distribute dividends. So it all depends on the stock you're buying on what you're going to get here. Okay. We also have something called bonds. And so people who buy stock become part owners in the company. Now, in order to raise money and not dilute the ownership of current stockholders, some companies sometimes sell bonds instead. Now, people who buy a bond are actually lending money to the company who they're buying the bond from. Now, bonds are a commitment from a company to pay the price an investor pays for the bond at the time it was purchased, called the face value, along with interest payments at a given rate. So you might buy $100 bond, and then they're going to give you a 7% return. So in X number of years, they'll pay you 7%, and it's compounded however they decide however it's compounded. So now, there are many reasons for issuing bonds. A company might need to raise money for research on a vaccine that has potential for preventing another pandemic that we just seen, so it issues bonds. The U.S. Treasury Department issues 30-year bonds at a fixed 7% annual rate to borrow money to cover federal deficits. So the U.S. does it as a whole. Now, local governments also issue bonds to borrow money to build schools and parks and libraries as well. So, there's local bonds as well. Now, bonds are traded like stock, and their price is a function of supply and demand. If a company goes bankrupt, bondholders are the first to claim the company's assets, and they make their claims before the stockholders, even though, unlike stockholders, they do not own a share of the company. Now, generally speaking, investing in bonds is less risky than investing in stocks, although what happens is the return is a lot lower. So, stocks you might gain 35%, where bonds you may be 7%. So, there's a big difference there. But, it's less risky because you get to get your money back first before the stockholders. Then we have something called mutual funds. So a mutual fund is a group of stocks and or bonds managed by a professional investor. So when you purchase shares in a mutual fund, you're giving your money to some fund manager. And then your money is combined with the money of other investors in the mutual fund. And then the fund manager invests this pool of money buying and selling shares of stocks and bonds to obtain the maximum possible returns for you. Now, a listing of all the investments that a person holds is called a financial portfolio, and most financial advisors recommend a portfolio that has a mixture of high risk and low risk investments. And this is called a diversified portfolio. That way, if you're high risk all of a sudden are losing a lot of money, your low risks aren't losing money, they're still gaining, but they're not making up for all the loss, but you're not at least losing everything in all different aspects of your portfolio. Now, investors in mutual funds own a small portion of many different companies usually, and that protects them against the poor performance of one single company. So some people like to buy, I'm going to buy all my investments in Apple and hope it does really well. Well, if you bought them a long time ago and now you're selling them, you're going to be very rich. But that's not always the case. Now, when comparing mutual funds, consider both the fees charged for investing and how well the fund manager is doing with the fund's money. So, when you're investing in these mutual funds, you have to pay so much percent to be able to invest in that fund per month. Sometimes it's per quarter. You have to read all the financial statements about how that all works. Financial websites publish ratings for these fund managers from 1 being the worst to 5 being the best of a mutual fund performance based on whether manager is doing a good job with its investors' money. Two numbers are usually given. The first number compares the performance of the mutual fund that you're buying into to a large group of similar funds. The second number compares the performance to funds that are nearly identical. Now, the best rating a fund manager can receive is a 5/5, and the worst is the 1/1. And most likely, you're going to be somewhere in between those two numbers. And so you have to kind of figure out what the best one is to do and go with what you're going to have there. All right, so those are some different ways of investing. So let's pause there and we'll come back for some more.